Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 4th, 2024. I hope you're all doing well. I appreciate you coming to my weekend review podcast. I hope you had a good trading week. Boy, market's been crazy lately, hasn't it? We'll get into that in today's podcast. Going to talk a little bit about the market in general, what I think the drivers of the market are, and what we can expect in the near term. Um, the format today, first of all, we're going to run that U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the positions and all the trades that I made last week, both on the daily time frames and the weekly time frames. We'll talk about when I entered the trade. We'll talk about why I entered the trade, what was my thinking, what was the strategy, what was the setup that I was using, and then most importantly, how I am going to manage the trade going forward, whether it goes my way or it goes against me. It's very important in trading, everyone, that you have a plan that tells you if it does this, then I'm going to do that. If it does that, then I'm going to do this. Once you've done your analysis, entered your trade, it's out of your hands at that point. The market's going to do what it's going to do, and you have no idea what it's going to do. And if you just come to that realization, it makes things a lot easier. You can't really will the market to go your way. If you could, man, I'd be all over that, but you can't. But so you have no idea what the market's going to do, but you have to know exactly what you are going to do. So you have to have a good process. And part of my process is I'm patient. I wait for price to get to a level or a combination or confluences of levels that tell me that, okay, maybe the stock is has stopped going down. It has other entry signals, so it has, whether it's MACD bullish divergences, RSI levels, moving average levels, V1s, V2s. Once that happens and it rejects a level, I go, okay, now it seems that it doesn't want to go down anymore. And if it doesn't want to go down anymore, it's probably going to go up. Then I need to position size based upon the volatility of the current market, volatility of the market, and the capital that I have in my trading account. I need to have a very good risk to reward ratio, so that if I'm wrong very small, and if I'm right, I have the potential for a large win. I place my emergency stop in case everything hits the fan. I take partial profits as it moves up, so I keep reducing my position and start locking in profits, which reduces my overall risk. Once it gets to a certain level above my entry, then I go into what is called trailing stop mode. It's very helpful. And then there's other resistance levels above that if they're rejected, then I'm going to get out. And so that's really what it is. And that's what I'll show you today in some of the positions that I have had. That exact thing, how I'm taking partial profits, when I'm going into trailing stop mode, why I'm getting out when I'm completely out of the trade. But, whether you learn your process from me or from someone else, it's imperative that you do. If you're just a discretionary trader and you're trading on a whim, hey, it's fun. I'll give you that. But in the long run, you have to fall in love with the process and don't worry about your profit and losses. Because if you do all the things that I say and be patient with winners and be very impatient with losers, over the long run, you're going to get this stuff done, right? You'll be a profitable trader if you do all these things and you repeat them from here till the end of your trading days. Doesn't mean you're always going to make money, but if you use the correct process with good risk to reward ratios, multiple confluences of levels going your way, then over time, at least in my opinion and in my experience, you'll make money. But most traders do the opposite. They hold on to losers, they get out of winners quickly, they position size too large, all the mistakes. So anyway, hopefully by going through this today with me, you get an idea of my process and how I get out of losers quick and I'm able to hold on to winners. So we'll go through the trades, talk about when I entered them, why I entered them, how I am going to manage them going forward. Okay, after that, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and follow the plan, and that comes down to trader psychology. So I always like to teach that. It's always helpful for me to teach it, and so I hope it's helpful for you to listen, and hopefully you'll take something away from that will help improve your trading. After that, I have gone down through my entire master watch list, both on the daily time frame and the weekly time frame, and I have identified some markets that I'm interested in next week. They're not at the levels they need to be, because if they were at the levels they need to be, I probably would have already taken the trade, right? But it's very important for me, at least. I usually do this on Friday nights. I go through my watch list and I say, okay, this stock, is it where it needs to be yet? No, it's not. It needs to go down another 2%. And sometimes it needs to go up more before I'll get into the trade. But you have to be patient. And like I mentioned at the very beginning of the podcast, let the price show you that it is, if you're long, that it is done going down and reversing back up at some kind of major support level. So on the dailies, I think I have to 12 that look pretty good to me. And look, if they come to the level that I need them to get to, then I'll consider taking the trade. If they don't, I'll just go wait for one of my other symbols to get there. And if they get there, I'll consider the trade. But when I it's possible that I could have multiple signals on the same day, but I want to wait for the setup that has the most confluences, combinations of indicators lining up. The more they have, the better chance that I'll have a profitable trade. So I'll go through those. I hope that's going to be helpful for you to kind of get an idea of the levels, and maybe you can start incorporating this into your trading as well. But all in all, waiting, being patient for a market to get to a level or multiple levels that are confluence or combination at the same time is extremely important. So I hope that's going to be helpful for you. And if anything I discussed today is helpful, if you find some value in it, I really would appreciate it if you could just hit the thumbs up button or subscribe. If you haven't subscribed, I appreciate you subscribing. But again, I hope this is going to be helpful for you. And I know it's been a crazy week, and we had a big up day yesterday. But I am also going to talk about the markets in general and kind of what I see. And spoiler alert, we are coming into some significant levels, resistance levels on the indexes. So we'll talk about that. We're going to talk about bonds. Bonds did break out a little bit yesterday into a bit of an uptrend because of the employment report and the unemployment report, which was actually worse than expected, which ironically, because of bonds, is good for the market. But bonds are going to be I think the main driver, or in other words, interest rates are going to be the main driver. And if interest rates start going down because the yields are going down, that will be bullish for the market, at least in the short term. So it's going to be interesting because on the indexes, we are coming in some major levels, but on the other hand, interest rates going down, that's going to be strong for stocks. So we're going to have to navigate all that, and I'll go into that, and hopefully that will be helpful and some value to you. I spent a lot of time doing this. This is my entire world, so we'll geek out on it a little bit and kind of discuss that. All right. So hey, to get things started, I have to run the U.S. legal disclaimer, so hang tight, and I'll be back in about 42 seconds. Thanks a lot.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Starting off with TLT. TLT are bonds, 20-year bonds. Okay, you can see the highlighted blue boxes I have here. You can see some up here. You can see some down here. These are what are called abandoned babies or island reversals. Abandoned baby consists of one bar. Island reversals consist of two or more bars. And if you'd like to learn more about abandoned babies or island reversals, please go to my YouTube channel. In my lessons playlist, you will see a video that I made on abandoned babies, island reversals, and why they are one of my new favorite indicators. I've been using them a lot lately. Sometimes they lend them. Sometimes of the year you get a lot of them. Sometimes you don't get a lot of them. But they are very good at calling tops and bottoms. And the reason I took the trade here on the 17th of April here at 8860. Why? Well, let's talk a little bit about what an abandoned baby is. An abandoned baby is a bullish abandoned baby is the prior day you gap down. So there was some bad news or there was some negative market sentiment that made the market gap down. Okay, happens all the time. But the interesting thing about abandoned baby is if the very next day it gaps up, it means that you've gone from extreme bearish sentiment to bullish sentiment in a very short period of time. So what does that really mean? It means that for whatever reason, the bearish sentiment was immediately reversed by the bullish sentiment. In my experience, and if you study these abandoned babies and these island reversals, you'll often see that a sudden shift in sentiment from negative to bullish immediately will more than likely, not all the time, but more than likely, you'll start to see an uptrend. You can see here the opposite. This is an island reversal. We gapped up, so things were great, and then gapped down very suddenly from good to bad. And so this was a bearish island reversal. Was that a good call to the downside? Yeah, exactly. I'll show you another one over here. Look at this one. Again, this is a bullish one, a bearish one. We gap up, things are great, and then followed immediately by a down move. So that was a bearish. Was it correct? It sure was. Was this one bearish correct? It sure was. Well, now we're starting to get some bullish ones, and that's, excuse me, that's why I took the trade. We gapped down, we gapped up. I waited for it to come down and fill the gap, which happened, and I got long here at 88.60. So when I take an abandoned baby or a island reversal, my exit is a little bit different than most of my trades. The majority of my trades, and I have some that I will show you here as well, I start taking partial profits. I get to a trailing stop level, and then I sell half if I have a close below previous bar's low, all that kind of stuff. And that's, this is what I teach in my private one-on-one lessons. But I like to have a little bit of diversity in my exit approach. So this one is quite simple. So once I have the signal of the abandoned baby, the gap down to the gap up, and again, got in at 88.60, this one's very simple. This is a set it and forget it type of trade. I place a stop 2 ATRs below my entry. And so if that happens, I'm going to lose 1% of my account. To the upside, I place my profit target 4 ATRs above. If it gets there, I'm going to make 2%. And that's correct trading, everyone. You have to have asymmetrical risk to reward ratios in your trading. You need to look for a setup that gives you an edge, and then place your stop with a 1% profit target and your 1% stop loss or loss, and your profit target 2 above. So this particular setup, the abandoned babies and the island reversals, the win percentage in my experience is somewhere north of 70%. So 70% of the time, I should theoretically make twice as much as I'm losing. That's pretty good, right? That's a pretty good proposition. Doesn't always happen like that, but over the long run, in my experience, that's what I see. So again, We have the gap down followed by immediate gap up. We have the bullish island reversal. I enter 88.60. I place my stop loss 2 ATRs below. I place my profit target 4 ATRs above. And that's it. I'm either going to come down here, lose 1%, or I'm going to hit my profit target. I'm going to make 2%. That's it. And, there's not a lot of, I guess I would consider these a swing trade, but they're more of a position trade, a little bit longer period of time. And it's kind of nice. You just, okay, I'm going to lose 1% or I'm going to make 2%. But I started with the premise of a setup that tends to win more than it loses. So if I make twice as much and the position tends to win more, that's a good start, right? So anyway, I bought it here. It was holding. We came down here, didn't get to my stop, so I was underwater on the trade at the end of last week, or the week before, and then now we've had this nice move up. So currently, this particular position, still in it, up 1.36%. The nice thing that kind of supports this trade right now is you see how we have the low and then we rallied, we made the lower low. Well, on Friday, we broke back above this pivot, which theoretically puts this into a bullish market structure now. I wouldn't be surprised if we have another day up and then a bit of a pullback, but I think after that pullback, we will start to have an easier up move leg, and I'm feeling pretty confident over time. This may take a month or may take 2 months that I'll hit this profit target, but we'll see. But again, bond prices going up causes yields to fall, and this is going to be good for that should be good for the stock market. Speaking of bonds, I want to take you over here to the yields. Okay, these are inverse. So the yields, the yields are going up. So interest rates are going up and up and up and up and up, right? But you can see this red band that I have here. This red band, I highlighted this fair value gap all the way over here. And we'll talk a little bit more about fair value gaps. But essentially, when you break position to the downside and then you rally into a gap, you're probably going to head down. And, this kind of gets into the weeds a little bit. And, I do a lot of this in my trading. I really look at the drivers of markets. If I'm trading stocks, I don't even really look at stocks. I look at interest rates. I look at VIX. I look at what the drivers are. But I highlighted this red here because once we got into this bearish gap, very likely it was going to pull back, or in other words, bond prices were going to go up, yields were going to come down, and you can see that's exactly what happened. So this is what kind of led me to take the bond trade, because I saw yields coming into this bearish area, and I knew that if yields started to come down, that bond prices would kind of come up. So kind of give you a little insight to how I look at which stocks that I'm going to pick, really based upon the drivers. But this has come down quite a bit. We're coming down to the 200-day moving average here. I would imagine the yields would probably find some support here, which means that bonds would probably find some bond prices would find some resistance here. But anyway, I know it all seems kind of complicated, right? But it's just kind of how I view things. I look at the different drivers. But nonetheless, this particular stock, or TLT, this particular market, doing quite well. But I am encouraged that we did break above that previous high, which puts us in a bullish market structure. So this one went up 1.36%. Okay, Home Depot. Okay, Home Depot, kind of a regular type of trade. This is a deep dip buy. I teach these in my one-on-one lessons. I also have a great deep dip buy course available at udemy.com. The link's in the description. And by the way, if you're interested in private one-on-one lessons, I teach a great course, 15 hours. It's a one-on-one course. There's 5 sessions. Each session is 3 hours. I teach you all of the different strategies that I use. I teach you step by step. We do all sorts of simulation trades, and when you're done with that course, I promise you, you are going to be a better trader. I've taught people from all around the world for many, many years, all the way from absolute beginners, didn't even know what a stock chart was, all the way up to the hedge fund level. So if you're looking for a good coach, if you're looking for a good teacher, that's me. That's me, and I promise you, you're going to be a much better trader. So contact me if you are interested in that. Okay, so here's Home Depot. I did take Home Depot here on May 1st. Why? This was a very easy signal to take. The 200-day moving average is a major moving average that generally offers a buying area for a lot of large financial institutions and savvy traders. And I like to key off of this 200-day moving average, either if it comes down, bounces, or closes below, closes above, or an intraday rejection, which means that during the day it went under the 200 and then closed above. You can see this was a completely legitimate trade here back on the 25th when it during the day went below and closed back above. So now it has the support of the 200 below it. I didn't buy it there, but I did buy it here on the 1st of May for the same reason. During the day, we went below the 200. At the end of the day, at the close, because I wait till the close to make my trades, it closed back above. Now, this is a higher low intraday rejection of the 200. This one did the same thing. It intraday rejected the 200, but it came from a lower low. This one came from a higher low. See how this low here is higher than here? But this is a very good example of what I mentioned at the beginning of the podcast. Look for a level to be rejected, position size correctly, place your emergency stop the way that I do it, 2 ATRs below, and my end of day stop is where? It's simply a close below the 200. Look at my risk to reward ratio. We're basically on top of the 200-day moving average. If the next day it had slightly closed below the 200, what would I have done? I simply would have got out. Right? I lose all the time, but the key is your losses need to be small and you need to have the potential on your winners for a big winner. And this is exactly what's going on here. So I saw the intraday rejection of the 200. I know that I have the support of the 200 underneath me. Out position size, place my emergency stop 2 ATRs below. My end of day stop is simply a close below the 200. And then I have this orange line up here. This orange line is my trailing stop level. It's 1.5 ATRs above my entry. So once I get to that level, now I go into what is called trailing stop mode. So are we at that level? We certainly are. Now I'm in trailing stop mode. All that means is that if I get a close below a previous bar's low, I will now sell half of my position, lock that in, reduce my position size. And so yesterday we got to trailing stop level. If it keeps going up, great. I'll continue to take partial profits. But if Monday or in the days to come we close below this level, that's a bad sign, and I will sell half. Let's talk about taking profits. So everything I've discussed so far as the position sizing, the end of day stop, the emergency stop, the trailing stop level, all these are defensive moves. It means that if it's going against me, I do something. But I also like to play offense. Just like any great sports team, they have to play good defense. The stops and the position sizing, trailing stop, these are defensive moves. But you also need to put some points on the board by playing offense. And the offense for me is taking partial profits if it moves up a certain amount from the close every day. I'll give you an example. Right now, the price is $342.85. Okay? So, just to give you an idea, this is what the math that I will do for Monday. Right now, you take the closing price, 342.85. I'm going to add the value of the 0.45 to it. Right now, the value is $2.74. So I add closing price plus 274, 345.59. 345.59. Okay, that is my first profit target for Monday. Then I take first profit target 345.59 again plus 274. My second profit target for Monday is 348.33. 348.33. That's my second profit target. And then we're going to take the second profit target, add it again, 274, 351.07. Okay, so 351.07 is going to be my third profit target. And so I always place 3 profit targets for the next day based upon the previous day's close. So if I get to 1 profit target, I'll take 10% of the position off that I started with the day. If I get to the second profit target, I'll take another 10% off. If I get to the third profit target, I'll take another percent off. A lot of times you'll hit 1. Sometimes you'll hit 2, which is nice. Sometimes you'll hit 3, which is really nice. Because what are you doing? You're taking profits into the strength and reducing your position size. There are days where I've hit 7 profit targets, if you can believe that. I only place 3, but if it keeps going up, I add more and more and more. All right, so to give you an idea, back to the entry, the intraday rejection or the 200-day moving average, okay, next day it moved up. I hit 1 profit target. Pretty sweet, right? On Friday, I did the same thing. I took the closing price here, added, and I hit 3 profit targets on Friday, right? And you can see I always place 3. So for Monday, I have 3 again. So I'm selling into strength. So this has been a really good trade so far. You can see it got higher. It did close lower, but I did take some profit targets up there. Lock those away. The market can't take it away from me. My position size is lower, which takes the heat off. And what does that do? Ultimately, really what's that does is the less heat that you have, the better you can follow your process. So my process here going forward is, if I get a close below a previous bar's low, I'll sell half. If it just continues up, I'll just continue to take profit targets. Once we get to a 65 RSI level, then I'll have another trailing stop of a close below the 5 EMA. If we get up to the 70 RSI level and reject it, I'll sell half of my position. If that happens, then the first time I have a close below a previous bar's low after reaching trailing stop, I'll be completely out of the trade. And I know this all sounds complicated, but in this short amount of period of time, you're like, what is he talking about? But it's not that hard. And again, in my private one-on-one lessons, we go through this for hours. You will know this like the back of your hand, okay? So anyway, this particular trade, doing really well, up 3.28% in 2 days. Very simple, rejection of the 200-day moving average. Okay, so that is Home Depot. Microsoft is another daily trade. Again, this was an abandoned baby. Lots of babies lately, lots of abandoned babies. Where was the abandoned baby on Microsoft? Well, pretty easy. We gapped down. Things were really bad. If you remember a week ago, things weren't looking so hot tamale, but followed by immediate gap up, leaving this all by itself. That's extremely bullish. I waited for it to close the gap. Gap down, gap up. I waited for it to close the gap. I got long here at $400.10. This is an abandoned baby, so I placed my 2 ATR stop below. I placed my 4 ATR profit target above, so that if I'm right, I'm making twice what I'm losing. Next day, market just cratered, getting kind of close to that stop, right? I thought, oh my gosh, I was really, really off on this. And it could have kept going down, and I would have just got out, and that's it. But then again, like I said, bonds started to catch a bid. This was bullish for stocks, and we went straight up. So again, I'm going to either hit my 2 ATR stop or I'm going to hit my 4 ATR profit target. And anyway, did get back into the profit here, up 1.66%. So on, let's see. So the open positions, TLT up 1.36%, Home Depot up 3.28%, Microsoft up 1.66%. Okay, let's get over to the closed positions. Don't always have winning trades, right? But what you'll see on the losing trades that I have, when I'm wrong, I get out quickly. Okay, this one's a bit of a hot mess. I mean, not really. It's just there's a lot going on here. I took this trade all the way back here on the 8th of April. Why? This was a bearish trade based upon the red bearish fair value gap. I got short here at 66.50. My stop was 68.20. This is a bearish position, so I placed my 1.5 ATR trailing stop below. And like I said, the stop was if we closed above this high, because this would now change it into a bullish market structure. So I got short here because of moving the price into the fair value gap, 66.50. And this is a really good example why taking partial profits, having trailing stop mode, turned this from ultimately what it would have been a losing trade into a winning trade. So I got short here, 66.50. Next day down. What did I do? I took some profits off, locked in the profits, reduced my short position. Next day, kind of closed about unchanged. Next day we went down. I took more profit targets. Next day we went down again. I took 2 profit targets. Then we kind of moved around here, didn't do much. Next day here, took more profit targets down here. And at this point, I'm at my trailing stop level, which means if I have a close above a previous bar's close, I will get out of half of my short position. That happened here. So I take profits, reduce position all the way down, take profits. Here's my first close above a previous bar's high after reaching trailing stop level. I got out here, locked in a 5.36% gain. And then we moved up. That's going against me. We have a big bar down. The taking profits was really great here because I reduced I made more money to the downside and reduced my position size. And then we just went up and up and up. And I got out of the remaining position for a loss of 0.76%. Very small. But did I still make money on this trade? Of course I did, because I took profits, locked in all half of the profits here with the close over the previous bar's high after reaching trailing stop level. I would have gotten out here anyway because of earnings. I never hold through earnings. So the remaining shares, the very small remaining shares that I had, was a loss of 0.7%. It's 0.76% on this short, but overall profitable trade because of the process and the playing offense and taking profits when I had them. All right, so the remaining shares, the loss on that, 0.76%. All right, let's go to FXY. Good example. This is Japanese yen. Okay, this is a baby. Whenever you see these blue bars, it's a baby. We gap down, we gap up. Okay, very bearish sentiment, very bullish sentiment. Came down, closed the gap. I got long at 59.06. I placed my stop 2 ATRs below. I placed my profit target 4 ATRs above. This is a set it and forget it. I'm either going to lose 1% or make 2%. And you can see on Thursday, got to my 4 ATR profit for a gain of 1.81%. That doesn't sound like a lot, but on a currency, that is huge. So another good example of looking for a setup that has an edge, that more times than not, it's going to move in the direction I want it to. And when it does do that, I'm going to make twice as much as what I've lost, right? Like I said, abandoned babies, island reversals, right about 70, a little higher than 70% success rate. But when you win and it works for you or works for me, I usually make 2 times what I've lost. And that's exactly what happened. So nice trade there, up 1.81%. And I closed the position and I'm out. Did go a little higher, but I closed the position and I'm out. Okay. Adobe was about the only real losing trade that I had last week. I got long here on the 26th of April. Great signal. Double bottom, bullish divergence, higher low V2. I got long here, 477.31. My stop loss on a V1 or a V2 was a close below halfway the washout bar. This is the washout bar. Why is it called the washout bar? Because it went below the previous bar's low, or in other words, washed it out and then moved back up. Got long here, 477.71. A stop is a close below halfway of the washout bar. Next day went down, moved sideways, and then here on the 30th, it's definitely closed below halfway of the washout bar, and I had to get out for a loss of 4.86%. And then it was very rude and immediately took off the other way, right? But it's fine. But what I'm trying to point out here is, yes, I have losing trades all the time, but when I have losing trades, I am out quick. I mean, look, I was in this trade for 2 days. That's it. 2 days. But when you see my winning trades, I'll be in the winning trades for many days. And that's the key to profitable trading. Being patient with your winners and being impatient with your losers. Like I said, I have losing trades all the time, but I'm usually in it for a day, couple days, I'm out. But my winning trades, I can be in for weeks. All right. So real quick recap on the daily trades. TLT open up 1.36%. Home Depot open up 3.28%. Microsoft open up 1.66%. PayPal closed. The remaining shares a loss of 0.76%. FXY closed up 1.81%. Adobe, which is the biggest loss of the week, down loss of 2.86%. So those are the dailies open and closed. Let's go to the weeklies. I also trade on weekly bars. Okay, here we go. This was a really, really good trade on CCJ. I got out of CCJ, not because my process told me to. It's simply that we ran into earnings, and I never hold through earnings. I did get get long CCJ back here March on the 22nd of March. Why? Okay, this is a different trading strategy. Great trading strategy. Again, I teach this in my private one-on-one lessons. This is called the return to value V2. Green line here, green line here. Anywhere in between here is considered the value zone. I like to buy in value, sell above value. Buy below value, sell in value. Too many people buy above value. It's the opposite. You should buy something when it's in value and sell it above value. So I don't mess around with buying stuff above value. But this particular setup, we were above the value zone clearly. That's requirement number one. Requirement number two, we have to come back into value. And then requirement number three is once we're in the value zone, I need to see some sideways motion. I need to see there's an equilibrium of buyers and sellers. And that's exactly what we got. Once all three of those conditions are met, then I need a trigger. Well, the trigger that I use for a lot of trades is a V1 or a V2. So let's look at it again. We're above value. We come into the value zone. Now I need sideways motion, got the sideways motion, and here we have a V2. Bar 1, bar 2 goes below bar 1. This is the washout bar. Bar 1, bar 2 goes below the low. Bar 3 closes above the close. This is a return to value, sideways motion, V2. Okay, place my emergency stop 2 ATRs below. My end of day stop or end of week stop in this case is a close below halfway of the washout bar. I place my trailing stop level, and then of course if it moves up the value of 0.45 ATRs from the close, I exit 10%. Okay, so I entered. The next week was kind of a nothing burger, didn't do anything, but didn't close below halfway of the washout bar. The next month or the next week, huge move up. I took a couple profit targets. Next week we went up again. I was able to take another profit target right near the top, and then it kind of moved sideways from there. And then last week, right before I had to exit before earnings for a gain of 13.07%. Pretty nice, right? Just very easy. Above value, return to value, sideways motion, V2 entry. Didn't know it was going to go up 13%, but this is what happens when you have good setups. You have the potential for that. But the main point is that my risk was very small if I was wrong. I knew exactly what my ultimate risk was. But again, risk to reward ratios and moved right up. So great trade, 13.07%. All right, so those are all the trades from last week, and we're going to talk a little bit about trader psychology, and then we'll get on to the trades for next week. Okay, let's talk a little bit about trader psychology, shall we? Okay. Again, everything in trading revolves around trading psychology, or in other words, following your process. You know, I beat this horse to death. Sounds bad because I really like horses. But it's true, everyone. I've been trading for over 28 years. I have gone through good times, bad times, rework of my process, rework of my strategies, but it always comes down to just following your strategy. There's human error in trading. That's why, you know, some people use bots and automated systems. Not a bad idea. Why? Because the automated system doesn't have a brain that goes, oh, well, should I? I don't know. I think it will go. I think this, think that. I'm actually a big fan of that, really. But trading has everything to do with the mind and following the process. So this is from Anthony Crudelli, great channel over on Twitter, X. Follow him at Anthony Crudelli. He's been a trader for a very long time, and whatever he posts something, I really try to read it and internalize it, and I want to share it with you here. Many of you who are struggling refuse to correct what you're doing wrong in the moments before you do it. The thrill of being in the market drives you more than the process. I get it. I've been there. Once you make a long-term commitment to yourself and your process, then you will have the ability to slow things down and commit to making changes in the moments before you're about to make a mistake. Have you been there? Do you understand this? There is a thrill to just being in the market. That's just a fix. That's just a chemical high dopamine reaction. But what you have to do is you have to separate and be disciplined about not getting your fix and just being patient and waiting for a real signal to follow your process. Because you're not always going to be in the market. You're not always going to have that dopamine high. And that's where people they just have to be in. Why be in the market if you don't have an edge? Right? Sure, be in the market if you have an edge and then follow your process. But what the interesting thing he says here about slow things down. You need to slow things down and get back in that correct mindset and that mind frame of being in a correct process, being in a correct, legitimate trade and having the ability to stay out when you don't. Why would you put a bet on something where you have no edge? Why would you do it? Successful traders only risk money when there is an edge, like an abandoned baby, or a rejection of the 200, or a return to value V1, V2, or a higher low V1, V2, or a crossover. But you have to be disciplined enough to take yourself out of the market when you don't have an edge. All right. And for people who've been trading for a long time, I'm sure you've been here. Slow things down. Get out of the market. Don't put your capital at risk unless there is an edge in your trading. Let's read it one more time. Many of you who are struggling refuse to correct what you're doing wrong in the moment before you do it. Or in other words, you get into a trade just to be in the trade. The thrill of being in the market drives you more than the process. If you have a process, your process is going to tell you not to be in the market sometimes. I get it. I've been there. Once you make a long-term commitment to yourself and your process, then you will have the ability to slow things down and commit to making changes in the moments before you're about to make a mistake. Or in other words, make changes. Don't get into something that you shouldn't be in just because of the thrill of the market. Slow things down. You know, I have a very good friend of mine who's been struggling in the market. And to me, it's clear that they've had losses. They're clear they're just in the market. They're trying to make back those losses. And they're in all the time. And I say, why are you in? You know, that direction doesn't look like it's happening at the moment. Yeah, but I need to make the money back. I'm like, I know, but just slow things down. Be patient. Do something else until you actually get a signal. So, you know, if you're struggling in the market's not going your way, just take a break, step back for a minute, and just wait for a real signal where you have an edge. So thank you very much, Anthony Crudelli. Please follow Anthony over at Anthony Crudelli over on Twitter and to X. All right, let's get to potential trades for next week. And again, if you found anything in this podcast helpful so far, I really would appreciate if you could hit the thumbs up button. Really helps to build the channel, helps to keep the channel around, lets YouTube know that there's some valuable content here. So if it's helping you in value, I would really appreciate that. Like I said, if you would like to learn with a professional stock trader, a great course where I teach you all of my trading approaches. We do all sorts of simulations. I teach you every single rule step by step and make you prove to me that you understand it before I'm done with you as a student. Please contact me. My course is $1,750, but I promise you it is worth every penny. I really think it will transform how you think about trading, and I'd love to work with you. So my email is in the link. Okay, let's get started. AMD. Okay, well, AMD is kind of interesting. Obviously, look at this move to the downside. Huge move to the downside, but we are coming to some important potential levels here. Right off the bat, we have the 200-day moving average down here. This is the black line. Down here, we have the 250-day moving average. Both of these are important key levels that if they're rejected, I would consider entering the trade on AMD. The negative third ATR channel, which is this gray line here, 92% of prices tend to stop going down when they get here or bounce. Well, look at that. Just Thursday, we almost touched it to the penny and bounced. Now, am I going to jump into this trade? Well, not yet. Either two of things are going to happen for me. One, we're going to have to come down, reject either the 200-day moving average or the 250-day if we go down. To the upside, you can see we're below the value zone, the green line and the green line. This is the value zone in here. One of my favorite trades is what's called a higher low V1 or V2. The requirement is you need to close below the value zone, move into the value zone, have a pullback again, and then get in with a V1 or a V2 trigger. So this is what I'm looking for. Either one, we come down, we reject the 200-day moving average. I would consider taking a trade there. Or if we head back up into the value zone, then we'll probably, if we head into the value zone, we'll probably have a bit of a pullback before we have a stronger leg up. And the reason I say this is when you buy at a lower low and you get into the value zone, the people that were fortunate enough to have bought down here will most likely be looking to sell there. So a lot of people just buy when it starts to get here, but they always get whipsawed by a move back down. That is because the people at the bottom are set, they've had enough profit to take some profit here. So two things on AMD. Either if we move down, a rejection of the 200 or the 250, I would certainly consider. Or again, if we move into the value zone, I'm not going to chase it there. I'd wait for a bit of a pullback and then a higher low V1 or V2. So that's AMD. Amazon, AMZN. Okay, we are, you can see in this red box here, this is an order block. An order block's the high, from the high to the low before market structure was changed to the downside. This is shortable right here, right now. I think what I'm going to wait for on Amazon is if we move up to the top of the order block and reject it. That would signal to me if the market reacted at that level and couldn't go any higher, that it rejected the high of the order block. Two things would happen. One, it would give me information that the high was rejected. And two, if I'm wrong, then my stop would be very, very close with just a close back above that high. So that's what I'm looking for. I mean, it is shortable right here. It's not like the most perfect setup at all, but I really want to wait and be patient for a really good setup. And the really good setup would be a rejection of this previous order block or the rejection of this high, 189.77. So if it rejects that high, I would get short, potentially get short, and then my stop would just be another close above that high. So that's how I'm looking here on Amazon. Bitcoin, BITO. Okay, so Bitcoin has really gone down. Look what happened here, though, the last few days. We had a bullish island reversal. We gapped down one day, sideways, up. Now we have a bullish island reversal. Let's take a look at some of the bearish. Look at this. Bearish, baby. Was that a good call? It certainly was. It certainly was. But now we have, there we go. But now we have the bullish island reversal. Could I have gotten in here? Yes, I could have just gotten in here. But I like to be patient and wait for the gap to close. So I'm waiting for it to come down to 24.22. There should be some inherent support here. If that's the case, 2 ATR stop to the downside, 4 ATR profit target to the upside. And this may just keep going and I would miss it, and that's fine. I don't trade Bitcoin a lot, but I do like this bullish island reversal here. And like I said, I could have just gotten in here. It would have been legitimate just to get in here, but I'm going to wait for it to come back and close this gap. And if it does, I'll consider taking the trade. 2 ATR stop to the downside, 4 ATR profit target to the upside. Dow Jones. Okay, so there is a significant bearish order block here. There's a gap from here to here, and then we change market structure to the downside. You can see as soon as we change market structure to the downside here, we had this high, we took out the swing low, turns into a bearish market structure. Once you got back into that gap, look what happened. Boom to the downside. So what I am looking for is a move back up into this fair value gap. And if it does get into that fair value gap, I'll consider getting short. My stop would just be a close above this high. So that's what I was saying at the beginning of the podcast. Yes, the market's rallying here. We may have another week of rallying. It's certainly possible, but we are coming back up into some of these major resistance levels and bearish fair value gaps. But again, bond prices are starting to move up, moves the yields down. That could be the driver for the market to go up. But anywhere in this area here next week, 86, you said. So $5-6 above here. In addition to that, we would be into the third ATR channel. Remember, 92% of prices tend to bounce here. 92% of prices tend to fail here. So that third ATR channel is dovetailing nicely into that bearish fair value gap. So I'll consider taking a short position somewhere between 392.40 and 394.70. And we'll see what happens. FedEx. All right, FedEx to the downside. Very obvious signal here on the 200-day moving average, the black line. It's also nesting at the negative third ATR channel. I like those confluences. What I also like too is you see the gray line here is above the black line. This is called the golden cross, 50-day moving average crossing above the 200-day moving average. Long term, this is bullish, but what I have noticed, some of the best 200-day rejections are when the first time you have a rejection off of the 200-day moving average, the black line, after the 520 is crossed. So here the 520 has crossed. After that happens, the first time you come to the 200-day moving average, I've had many trades over my career using this 50 crossing over the 200 and then the price coming back to the 200. That really improves the chances of the trade. So that's what I'm looking for next week on FedEx. If we move down, reject the 200-day moving average. In addition to that, the negative third ATR channel is there. That also helps the bulls case. And then the 50 crossing over the 200, and then it coming to the 200-day moving average the first time after the cross, that helps. So I do really like this. I don't know if it's going to get there, but if it gets there, I will certainly consider taking the trade. Russell 2000, again, the indexes are getting kind of close to this serious resistance level above. Massive. Here we go, the high and the low of the order block before the market structure was changed. We are coming into this level. This big bar here, the big down bar here, whenever you have a big outsized down bar, if you get to halfway of that, there tends to be resistance there. That's why I put the red line in the middle here. So we're inside a bearish order block. We have a big down bar. So if we get up to 205.60, which is a few dollars away, I will definitely consider getting short IWM. My stop would just be a close above the high of the order block. So, I would have a 205.60 up to 207. So, I probably have $1.40 potential for a stop loss. Pretty good, right? But that's what you need. You need small, very good risk to reward ratios. When you're wrong small, and that would do it. But a lot of confluences here with a bearish order block and the big down bar here, halfway here. So 205.60, I would be considering a short. Johnson & Johnson, okay, a little different. This is bullish, and this is a bullish fair value gap. Why a bullish fair value gap? Well, you can see that we have this swing high over here, and we took out the swing high. That changes it into a bullish market structure. If you have a bullish market structure, then the fair value gap is what you're looking for. Okay, so I'm looking for this fair value gap here in between 147.50 and 145.80. If we come down into this blue area, that would be considered a buy area for me. My stop would be the low of this order block here. So this is an order block. This is the biggest down move before you change market structure to the upside. So this is what I'm looking for. Potential buy on Johnson & Johnson, 147.50 to 145.80. And what I've seen in the market, that I've seen last week when the market was going down, you saw a flight into kind of some of these more defensive types of stocks like tobacco and consumer healthcare and pharmaceuticals. Yes, we've had a bit of a down move the last couple of days because there was some rotation into tech, but that may be short-lived. And based upon what I showed you on some of the indexes, I think that's short-lived. And so we have changed market structure to the upside here. Once you change market structure to the upside, the proper move for me is to buy the dip. So somewhere a potential buy 147.50 to 145.80 is what I would be looking for a buy on J&J. McDonald's, okay. McDonald's, we have an order block back here on the 16th. This is the lowest low before market structure change. We changed market structure to the upside here when we took out this swing low. So this leaves a fair value gap here between 268.90 and 267.10. Do you see how on Friday we literally got to the top of that bullish fair value gap? Literally got to it, and that's exactly where it stopped. Pretty interesting, right? So if we continue down next week somewhere between 468.90 and 268.90 and 267.10, this little area right in here would be a potential buy. My stop would just be a close below this low here at 265.15. So I think a good risk to reward ratio. We did go into a bullish structure. We had earnings which looks like really bad, but the market shrugged it off. But again, I'm seeing the McDonald's and the Johnson and Johnsons and these type of defensive companies, the Philip Morris's, the Altrias, right? These defensive plays, I'm starting to see money coming into these. Because of the big move in tech on Friday, they came out, and that's why you see these moves down. But I think this is an opportunity to buy these. So from 268.90 to 267.10 in this fair value gap here would be an interesting place to potentially get long McDonald's, and the stop would be very close here with a close below 265.15. Let's go to the Qs. Okay, well, all right, yes, things were falling off a cliff. Now we're coming back. You can see the red area here, which is the resistance area. Why? Because it's the bottom and the top of the order block before the market structure change to the downside. You see I have the highlighted bar here, 441.20. Why is that significant? Well, one, it's inside the bearish order block, and two, you see the big bar we had here on the 4th, the big move down? Well, if you get back to halfway, that's going to be resistance. Look, on the big bar that we had, the next couple days flirted with this halfway, rejected, then we had the big move up, couldn't get above that halfway, and then move down. So I do believe that there'll be some inherent resistance for the Qs somewhere between 437.90 and 446.50, but the ideal spot for me to get short would be right here, 441, because it's inside the bearish order block, and it's halfway of this big bar down, which was on January, February, March, April 4th. So basically the level that I'm looking potentially short Qs is 441.20, so that's still $6 or so above, and so that's why I'm still thinking that we could have some movement up, but I'm certainly considering shorting the Qs at that level. SPY, it's going to be similar. Again, we have an order block here. This is the biggest up move before structure change. We did get right to the bottom of that order block and rejected a little bit on Friday. But the key level for me, I'm just going to be very patient with this, is going to be 518.10. Again, it's inside the bearish order block, but it dovetails with this big bar on the 4th where we gapped up, came back down. And if we retrace back up to the halfway, there should be some inherent resistance there, 518. So that's still $6.50 above where we're at. And, I feel like that may be a magnet for the market. But once we get there, I think that's going to be a very difficult place to overcome. So if we go back up, reject that 518.10 area, I would consider getting long SPY. So you can see why I'm a little bearish in the market within a couple weeks. I still think we can move up. Still think there's going to be some momentum from Friday because of the bond prices. And of course, it's all going to matter. If prices continue to go up, you're probably going to see SPY get to these, SPY and the Qs get to these levels that I'm talking about. All right, so that's what I'm looking for on SPY, is right there, that level 518.10 for a short. And then my stop would simply just be a close over the high of that order block. So a very good risk to reward ratio. Look, I get short 518.10, my stop would be 519.50. Very good, very small risk, but it comes at a confluence of areas that would make sense to get short. USO, all right, well, oil has just fallen off the cliff, but not hearing much about oil anymore, but there are some potential levels that are coming into play here on oil. 200-day moving average makes a lot of sense. We're at a 32.37 RSI. Well, some of the best confluences that you can get is when you have a confluence of a rejection of the 200-day moving average and a rejection of the 30 RSI. Again, this is what I teach in my one-on-one classes when I teach the deep dip buy stock trading strategy. Are the confluences of the under 30, over 30, and the rejection of the 200-day moving average right here, right? And again, we're getting close to that level. Blue box, 200-day moving average. Oil going down, this is going to help out the CPI. That's, again, while I'm bullish on bonds. But at some point, we're probably going to get some kind of bounce, and the 200-day moving average and the 30 RSI would make a lot of sense. So that's what I'm looking for next week. Either a rejection of the 30 RSI or a rejection of the 200-day moving average. Ideally, both of them would be the best. And then last but not least, Verizon. Okay, Verizon, I'm looking for a short. Remember when I just talked about big down bars, and that if you rally back up to halfway of that bar, you're going to have some inherent resistance? Well, look, exactly. Look, we had the big down bar. Look, the next day we got right to half, failed. Got right to half, failed. Something happened here. I'm not sure what it was, but it didn't work all the way down. I'm looking for a move back up on Verizon to halfway of this bar, halfway this big down bar here, 39.90. And then if I do get short there, my stop would simply be a close above high of this first swing bar here. So don't know if that's going to happen, but that would make the most sense. You can see when you have a big bar down, it tends to get to about halfway, and that's about all she wrote. So if it continues to get back up to halfway there, I'll take a shot at it. It may just continue right back down, or it may head back up over here, and that would be the end. So these are what I'm looking for. And by the way, just want to point out that, it's potential that all of these potential symbols that I've just gone over could trigger on the same day. Does that mean I'm going to take all the signals? No. I have a policy in my trading that I only take one swing trade per day. So if all 12 of them were to trigger, how do I narrow it down to the one? Well, which one is going to have the most confluences and combinations of indicators lining up? Which one looks better, or which one has the most confluences and levels of support on the higher time frame? I don't just look at one time frame, I look at two time frames. Which one has the best risk to reward ratio? Which one is strongest relative to the market? So these are all the things. It's like a filter. Okay, 10 of these triggered. How do I narrow it down? Best risk to reward ratio, best combination confluences of indicators, best relative strength, best look on higher time frames, right? And you have to narrow it down to the very best one. And this takes some skill and this takes some experience. And again, this is what I teach in my private one-on-one courses, how to narrow down to the best one, because the one with the best quality score is going to be the most likely one to be profitable. And even with the perfect score, doesn't have to be profitable, but it helps. Okay. All right, let's go to the weeklies. I think I only have one. I went through the entire week and all I could find is one, and it is Boeing. Boeing has been very, very out of favor. You can see it just was a straight down move. We had earnings gapped up, reversed, and then sneaky right back up. But I'm talking about this on the weekly. What am I looking for? Okay, well, we had some confluences of signals on Boeing. We went under 30, over 30, but now it's a little bit chasey. It's a little bit stretchy. I'm not gonna go after it up here. What would make sense to me is if we had a little bit of backfill and got halfway of the washout bar in the V2. See the V2? Bar 1, bar 2, bar 3, 2 goes below, bar 1's low, 3 closes above, bar 1's close. This is a valid signal. This is a V2, but it's a little bit temporarily overstretched at the time. What I would like to see Boeing is a little bit of backfill, find the support of the halfway of the washout bar here, 167. So that's about 12 points lower. I don't know if it's going to get back there. It may not, but if it does, it would give me a very good risk to reward ratio, because if it got back to halfway and I entered, then if I get a close below halfway, I'm simply out. It just comes down to risk to reward and being patient. Now, if this just heads on up, will I be like, I wish I would have gotten this trade? No, I won't. I don't care, right? I've been doing this for so long. I really don't care if it gets away from me, because I'll have something else. But if it does, this to me, that there's a change in structure, that especially on the daily here, there's a change in structure. We have gone into an uptrend, but once you go into an uptrend, it doesn't mean you just tend to chase it, because a lot of times as soon as you go into an uptrend, you get this, for some reason, you get this pullback, and that's your key to buy. After you have a break to the structure in the upside, wait for the dip. It's the old saying, buy dips in an uptrend. And generally when you go from bearish to bullish structure, you initially get a quick move back to the downside, and that's what I would be looking for. So on the weeklies here, just looking for a pullback here to halfway of last week's washout bar, about 167, and then I would buy and then wait one more week, and if it closes below, I'd simply be out. So those are what I'm looking at next week. I appreciate you being here, everyone. And like I said, if you did enjoy the podcast today and you found something of value, please hit the thumbs up button or subscribe. If you're interested in private one-on-one lessons, I promise you I'll teach you everything I know, and I know it will have a meaningful, positive impact on your trading. And all you have to do is email me. We can get the conversation started. If I do hear from you, I like to set up a Skype call. It's free. I just want to learn more about you and your trading challenges, your goals. It's a great time for you to ask me any questions about the course, about the syllabus, and what we study in the course and how it's going to work. And then when we're done with the call, then it's totally up to you. You think about it, and if you want to do it, then you just email me back, say, okay, Greg, I'm ready for lessons. We'll set up and we'll get running. But there's never any pressure. So if there's interest, just email me. Again, I have a great course at udemy.com. It's very, very affordable. And the course on the deep dip buy course is 9.5 hours of video. It's 26 video. I teach you step by step the deep dip buy strategy, which is a really, really good strategy. I always like to leave off with, please try to go out and do something nice for someone today. Please be kind to people. Please try to do, one act of kindness a day. If we all did that for everyone, it would make the world a better place. If you could also do that for an animal, I would really appreciate that. They appreciate acts of kindness just like we do. I'm a big animal lover, grew up with many of them, and I know they appreciate acts of kindness, right? So I think that's it. Please be careful next week. And, above all, get yourself a process, follow your process. If you have any comments or questions on what I discussed today, please type them in. I will do my best to get back to them, but God willing, I will be here next week and we'll discuss what these markets are doing. But be careful, follow your process. All right, everyone, appreciate you, and enjoy the rest of your weekend. And on the way out here, I have to run the Yoast disclaimer. Take care, everyone. Bye-bye.
Government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.